Hello and welcome back to the Moneycontrol live stream. You are watching Markets with Santo and CJ. Well, the market looks all set to snap a 3-day losing streak as bears are running to cover their short positions ahead of the expiry of the May derivative series. If you look at the Nifty 50 and Sensex at this point of time, Santo, they look like they are going to hold in the green territory for the time being, and we might see a green close. Finally, after the script was almost written for the market, it seemed just an hour ago the Nifty and the Sensex were both in the red territory after a very strong start. The same script that we have seen from Monday to Wednesday, but in the last hour there has been decent amount of short covering coming into the market, and we saw even the Nifty Mid Cap and Small Cap Index return to the green territory, although they have given up some of those gains, and probably the Small Cap Index was trading in the red zone, mildly in the red zone. Apart from that, if you look at some of the sectors that are doing well, banks, metals and IT are the ones who are leading the revival for the bulls, largely thanks to short covering, because these are the sectors who have taken it the most on the chin in this derivative series, especially IT and metals. Santo, we know what has happened with steel stocks just a few days ago, and IT stocks seeing downgrades from both JP Morgan and Nomura during the past month. So yeah, it seems like we're finally going to snap out of that weak run of negative closing. But I'm sure that you are very skeptical about this move.
And there are good reasons to be skeptical still. CJ, of course, it's been quite a volatile day today and a good comeback also, but it still doesn't change the bigger picture. My concern still is the sustained amount of foreign fund selling that you continue to see. Now, this in 2022 alone, you have seen close to about anywhere between $25 to $30 billion worth of selling, which leads many to think that the selling might be done with. But if you look at the overall FII exposure, it's still at about north of 600 billion. So they've still sold a very small portion, and if the selling continues at this pace, it's hard to see how much retail will be able to absorb, because already you're seeing some bit of fatigue on the retail and HNI side. That's the feel I'm getting when speaking to brokers.
I think only you are getting that feel. The retail investors I'm talking to, they seem pretty much intact to buy this dip.
So that's the other thing, CJ. Because of that, I think the market could still take some more time to bottom out, because the markets don't typically bottom out.
This is a grind. This is definitely a grind.
And also, you see the kind of buying appetite which was there, certainly, but that has considerably now diminished, because of the sustained fall. Yet at the same time, there seems to be some hope, because of which I think, as I said, market will take some time to bottom out.
And silver linings are what we are all about at this point of time in the market. We are all looking for silver lining in the dark clouds that have surrounded the bulls over the past 4 to 5 months. That said, there was a lot of action, in among specific stocks, and we picked out 5 stocks that we definitely were looking out for. Starting off with Santo.
BPCL. Now the stock has been under attack from the bears over the last few days, especially with the divestment plans undergoing a major shift there. But that probably could also, be some kind of an opportunity, because if you look at the refining margins, they have been pretty strong. Now the big negative for most oil marketing companies was that they have not been able to raise prices, and because of which they are suffering losses on the marketing side of the business. But if you look at BPCL's 4th quarter numbers, according to analysts, the company's refining margins have been quite strong and have in fact helped make up for some of the losses which were suffered on the marketing side. So this, CJ, probably could be an opportunity in disguise.
I doubt, Santo, I doubt. See, BPCL's entire story for the past 4 years has been the privatization of the company. Without that privatization now, it seems unlikely that it will happen, if at all. I don't think there is much of an investment case for BPCL, given that this is a state-owned refiner in a very, very high crude oil price environment, where government, now we have already seen that the government wants to go hammer and tongs against inflation at this point of time. So it seems very unlikely that the BPCL companies like BPCL will be able to recover some of the losses that they have borne over the past 3 to 4 months because of the lack of price hikes, even though oil prices have sustained over the $100 mark for close to 2 months now. Now, there is no sign of crude oil prices easing at this point of time, but at the same time, there have been no signs that OMCs or refiners want to raise pump prices at this point of time. So given that, taking that into account, I feel that profitability will remain under pressure. going forward. Even though refining margins are strong, they will be offset by the marketing losses that these companies are going to face in the coming quarters. And if crude oil prices rise even further, which some of the analysts out there are actually expecting oil prices to go beyond $150 per barrel at some point later this year, I feel that things are going to get pretty ugly for refiners like BPCL, and therefore for me, the stocks is.
Well, the general outlook is that crude prices are expected to stay firm, but not many people are now betting on it continuing to rise at the same pace as it did during the initial part of this year.
Yeah, maybe it will not rise in the same, it may not see the same rally that it saw in the first quarter of this year, but definitely it is trending upwards. Even if you go by the positioning that a lot of traders have on crude oil, they are still quite bullish on that commodity, and therefore for me, I rather not take that risk at this point of time in a market where your capital can evaporate at any point of time, right? BPCL, therefore, for me, is a bet better avoided. There are better opportunities out there. And talking of opportunities, Home First Finance is definitely looking like one opportunity. It's a mid-cap, NBFC which primarily deals with first-time home buyers, especially in the affordable housing scheme. Now we know before the the recent pickup in residential sales, especially on the premium side, it was the affordable housing which was actually driving or keeping the real estate sector above water, and that segment has shown great demand over the past 4 to 5 years, largely given the help that it has got from the government. Now the stock has been showing strength in the past few weeks, even in a very weak macro and market environment. Apart from that, a very influential PMS, Marcellus Investment, has added the stock in its Little Champs portfolio, which goes to show that they are very bullish. Somebody like Saurabh Mukherjee is very bullish on the segment as well as on the company. Marcellus expects strong earnings growth from here on and AUM growth. Now remember, Home First has given about 50% annualized growth in its asset under management over the past 5 years, and Marcellus is betting that growth journey will continue over the coming 5 to 10 years for the stock. And these are fund managers, Santo, that do not chase momentum, right? They chase earnings, compounded earnings, consistent earnings over 10-15 years. So therefore, going by that and going by the strong asset quality base of the company, as well as the rising the good environment for home loans in general, if you look at the commentary from bigger NBFCs and private sector lenders, I feel this is one counter that investors could definitely get in.
Well, CJ, the environment for home loans, the real estate sector as it is as a whole is changing a bit, definitely. And I think rising rates will probably lead to some bit of moderation also as far as this home loan growth rates are concerned. Now, coming to Home First Finance, well, I would say that, it's still looking expensive to me compared to some of the other more established names in the market at this time. For instance, you would get HDFC at 2 times book. Of course, at some point it's going to merge into
exactly.
HDFC Bank, but even then, till then, you still have HDFC which is going at 2 times book, and you have LIC Housing Finance which is available for less than book. So why would you pay something like 5 times book for a Home First Finance?
I'll tell you why, Santo. It is because of the good asset quality and the good management track record, right? LIC Housing Finance during the downturn was one of the worst affected NBFCs in the country in terms of poor asset quality. Now in Home First Finance, despite going through the entire IL&FS crisis and the pandemic crisis, it has been able to maintain its gross NPA ratio at sub 2% levels, which is an amazing feat for a company so small which has been chasing growth, right? So that is why, given the strong asset book of the company, I think that is the reason why investors are willing to pay that premium price to book value compared to somebody like LIC Housing Finance.
Well, InterGlobe Aviation, the next stock on our watch list, the company reported its quarterly earnings yesterday, and only to be expected, high crude oil prices, jet fuel prices are clearly weighing down on the company's bottom line, and the company slipped into a loss. But analysts tracking the stock feel that if you look at the yield per passenger, that's been showing a very heartening trend, and this quarter, which is the April to June, is when actually a lot of this holiday travel does take place. So you are probably looking at strong numbers for this quarter, which is what also the market seems to be factoring in. You saw a bounce in the stock today after sustained losses over the past few trading sessions. So this is a stock which is a play on rising travel. Even business travel has started to pick up, and of course crude oil prices, I see them kind of leveling off here on, or not rising at the same pace as they did till some time back. So I think that factor would be to large extent be taken care of by the rising yields.
But Santo, I am really concerned about InterGlobe on two fronts basically. A, of course, you mentioned about the profitability and crude oil prices. As I mentioned earlier, crude oil prices are nowhere near their peak at this point of time. If you go by the positioning and if you go by the chatter out there in the market, crude oil prices may go for another rally in the latter half of this year, especially as China comes back after the reopening, right? The demand scenario will look better, and therefore the margin pressure or the cost of fuel, jet fuel, will continue to rise for InterGlobe. Remember, 40% of its cost structure is all about jet fuel prices.
So but they also have long-term contracts, right? They don't, kind of bite month after month. So once you have locked in, probably that stays that way.
True, so but that also means that in the future, when they will have new contracts renewing, those contracts will be renewed at a much higher prices, and therefore
or at a much lower rates.
I doubt that. I sincerely doubt that. Apart from that, of course, this is the near term, right? But in the long term, there are two new players who are coming into the market, especially in the segment that InterGlobe is all about, low cost airfares. You have Rakesh Jhunjhunwala backed Akasa coming into play later this year, and you also have the revival of Jet Airways happening. Jet Airways has recently revived its license to fly aircrafts once more, and with two new competitors coming into the sector, I think InterGlobe's margins also will come under threat. Its market share will come under threat, largely because both of these competitors will be looking at InterGlobe first, then premium air travel. They will probably be looking into that segment much more. And at the same time, Air India is now under a new owner. They are under a private sector owner who will be more competitive, who would want to go after the market leader, and they are trying to regain their lost crown. So these are very tough times to be in the air industry. And as Warren Buffett once says, they do not make money for you, but they end up losing capital instead. So that is one sector that I will definitely stay away from.
Well, as far as the point on competitive intensity, see, IndiGo has been now around, in the market for quite some time now. It's not new to competition. It's managed to hold its ground all these years. So I don't see that as the big challenge.
It has been able to hold its ground largely thanks to the chaos that was Jet Airways, right? Jet Airways going out of business was like a heaven sent for InterGlobe, because it was automatically able to take away all of Jet Air's market share, while the nearest competitor, SpiceJet, was still grappling with a lot of its own issues. But now with two new players coming in with good amount of capital backing, good management as well, I don't think that it's going to be the same situation that it was maybe 3 to 4 years ago. That said, one stock that is looking up right now in the market is HEG. Now this is a graphite electrode player and very closely linked to the steel space. If you look at the commentary that has come in from the management, while the March quarter earnings were decent and were resilient, it is the commentary that has really heartened investors. They are expecting realizations in the sector and their own realizations to rise by another 4 to 5% in the June quarter as well as in the September quarter, which suggests that margins are largely going to be quite okay, while top line growth is going to be very healthy. They have also assured investors that margins will sustain at the Q3 levels going ahead. Therefore, they may not see as much hit from rising cost or rising fuel prices as some other peers in the industry are looking at. So therefore, HEG, good bet on a stable earnings foundation, and therefore probably if you're looking for hiding bets, as counterintuitive as it seems, HEG could be a good play there.
Again, when you look at the price chart, CJ, it's very surprising. This quarter was going to, this year, that's FY22, sorry, last year was going to be good, and the market had fair indication of that. The stock topped out pretty fast, around October it hit a high of 2,500, and then since then it's been steadily falling. So it's an indication that probably market has already discounted the earnings, and what you're seeing right now is the best.
I doubt, Santo. I think probably market had discounted FY22 earnings, and therefore you had seen the highs and therefore the lows, especially when the sentiment turned around commodity stocks late in 2021 and recently the past few weeks in 2022. But FY23 earnings, there still remains to be a lot to factor in. These stocks have, especially HEG, has gone through a decent amount of correction from its record highs, and therefore I think valuations have also become reasonable. And with the commentary as strong as the management has given for FY23, I believe that there is still a lot of upside that the market has to factor in terms of earnings growth for FY23, because they would have probably seen the way steel stocks have been downgraded and done the same for HEG and Graphite India, who are largely proxies on steel sector. But I feel that given the commentary, the sudden, the optimism that is coming from the management, there is still room for upside.
But just step back 2 more years, sir, the market does get excited on graphite story very quickly, and that's what saw the stock climbing to about 4,500 rupees in 2019, and that year was kind of really blowout earnings, 6,500 crore worth of revenue, which you have not seen now almost in 3 years now, right? So will the company see that kind of earnings is also something?
Well, they have indicated they expect 7 to 8% volume growth going ahead, which is decent in an environment, in a macro environment like ours. I think that is a very good run rate to have in terms of volume growth. So it is right now probably this will not be a great earnings year for the company, but given the volatility that the sector is generally associated with, a stable earnings quarter, earnings performance like this could actually get them some favor with investors.
Last stock on our watch list is Torrent Pharma. The company reported a loss for its fourth quarter, but that was largely due to exceptional items. It took an impairment provision on its US business, one division of its US business. That apart, the overall analyst sentiment on the stock is quite positive. They see strong growth. Already in Q4, you saw good numbers, good growth both in the India as well as US and Brazil businesses, and analysts expect to continue. They expect to see this trend continue in the coming quarters also.
Well, Santo, I think the domestic business might save Torrent Pharma's day, but it is the high margin US business that I'm really concerned about, because this was supposed to be the growth business for Torrent Pharma, right? Although they are largely dominated by their domestic sales, but the US market is where the management was trying to really push itself to get into those high margin product segments, and things have not worked out very well, as the impairment in the March quarter has shown. The overall US business, the US drug market is going through renewed price erosion after seeing some sort of betterment over 2018, 2019. Price erosion has again become a big threat in the US market, and therefore I feel that probably even if the top line performance is good, led by India, the profitability could remain subdued or negative over the FY23 period. Apart from that, if you talk about upside, if you're trying to play into an upside also, the consensus price target for the stock is just 10% away from the current level. So basically, you're basically betting on 10% sort of an upside over a 12-month period, which does not seem to be much, to be excited about. There are better plays out there, as I mentioned, HEG, which can give you much better returns over that time frame.
See, management guidance is quite strong for this year. They have guided for double-digit revenue growth in both the India and Brazil business. In addition to that, they have also guided for an upward revision of 300 basis points in its operating margins. Now, as for the consensus price target, CJ, typically markets tends to overshoot on both sides. Probably it's because of the sharp erosion in share price that many analysts have now turned cautious and are giving a very guided price target.
Give our analyst friends some credit. They are not that bad.
Yeah.
That's it, Santo. I believe you have spotted something strange about IndiaMart Intermesh's buyback offer. Is that so?
Yes. Now, the company had come out with a buyback offer that announced it last month at 6,250 rupees per share, the total of about 100 crore, and 160 lakh shares is what exactly the size of the buyback. Now, a few things interesting about this buyback offer. Now, in this case, the promoters are also participating.
Right.
Now, which is not
that
very
per se a negative, I guess.
It is not very uncommon, but now you also need to be mindful of the fact that in February 21, the company had raised about 1,070 crores by placing its shares at 8,650 rupees.
Yes.
Now you sell shares to investors at that price, and then a year later you're participating in your own buyback. And if the promoters themselves are getting out of the company, what confidence does it give to investors? The second thing,
I told you, when you remember on the show also, we had touched about IndiaMart when they had come out with the buyback offer, and I told you that why would a growth company like IndiaMart, which has raised capital for growth purposes, suddenly go and invest it or put it out in a buyback instead of probably investing in businesses that could help the company grow.
And the second thing is that if you're a small investor in IndiaMart, then you don't really get to participate in that, because
why?
The company has said that the minimum you need to have at least 63 shares to be able to participate in the
What sort of a condition is that?
Yes. So that means that most of the small investors will not be able to participate in that, because it's average holding size of the individual investors, those who hold up to 2 lakh rupees worth of shares, is about, they are holding about 16 shares on an average.
Wow.
And 63, if you have
So
63,
that means almost every average retail investors will not be able to participate.
yeah, and mostly it will be
issue.
the institutional and investors as well as the promoters which will be gaining the most from this. So you've already seen a very sharp erosion in the stock price over the last 1 year, and if small investors were hoping for some relief, well, that's not going to come.
Definitely, that does not look a very pretty picture for at least the retail investors. I mean, I would feel very hard done by if this had happened to me.
Well, a quick look at the market before we, Nifty 50 is at 16,100
and Moneycontrol app
86. It's
we have risen more, Santo. It looked like that we were coming off highs, but Sensex and Nifty are both higher by 1% at this point of time. And even the Nifty mid-cap index is up by 1.5%, Santo. That is quite a comeback from the small caps as well. If you look at the small cap index at this point of time, I think that is higher by 1%, if I'm not wrong. So, yeah, about 0.9% at this point of time. Things are looking very, very good.
Good, but CJ, I would still say that one has to be very cautious in this market. If you're buying the so-called dip, right? You need to be very nimble and agile, or you're just going to get slaughtered.
Well, nimbleness and agility is all that I've got. That's it. I mean, look at the names that are leading the leading gainers on Sensex. This is Tata Steel, about 5.2% higher. SBI, HDFC Bank, Axis Bank, HDFC, and ICICI Bank. And remember, these are all the stocks that have taken a lot of beating this May series, and probably had a lot of short positions in them throughout the the expiry season, and therefore probably right now we are seeing that square off happening just hours ahead of the expiry of the May derivative series. And I mean, you could read what you want to it. This could be a dead cat bounce, or this could be the start of a new pullback for the market.
Well, that said, what do we have on the horizon, CJ?
Well, Santo, there is a very crucial macroeconomic data that is going to come out in the US. The personal spending data for month of April will come out later this evening, which will basically, it's important. Why? Because this is the first data point that is going to come out on the personal spending space amid the high inflation that we have seen in the US. And investors will be looking for signs where the consumer spending is slowing down because of inflation, which could trigger more growth and recession fears in the US, or whether it is holding firm, which could again be detrimental, because then you would probably see the US Federal Reserve probably upping the ante on its fight for inflation. So that will be one crucial data point. Apart from that, earnings will be, there are some important earnings coming out tomorrow, including Nykaa. You have Info Edge and JSW Steel also coming out with their March quarter earnings. So these three stocks will definitely be in focus in tomorrow's session.
And we'll track these stocks. We'll keep a keen eye on these stocks tomorrow. Well, that's all that we have in this edition of Market with Santo and CJ. Hope you enjoyed watching this show.
I'm sure they did.
Please do share your feedback in the comment section below.
And do follow us on the social media links that you can see at the bottom of your screen. Also, do not forget that Moneycontrol is bringing you live coverage from the World Economic Forum. So stay tuned for all the live updates from ground zero as we bring you the great voices, diverse voices from that economic forum. Apart from that, also stay tuned to moneycontrol.com and the Moneycontrol app for rest of your financial news. And we will see you tomorrow morning at 9 a.m.